Micron just reported a tenfold increase in profits, and the conversation around Wall Street is whether the stock will crash anyway. Let that sit for a moment. A company multiplies its earnings by 10, and analysts are debating a crash scenario. That is not a glitch in the matrix. That is how late-cycle growth markets actually work. And if you do not understand the mechanism, you are flying blind right now. So here is the question this video answers. When extraordinary earnings are not enough to save a stock, what exactly are markets pricing in? And what does that tell us about everything else in the tech complex today? Step back from the Micron headline for a moment and look at what else happened in the same window. Korean equities just suffered a 10% rout before rebounding, with attention shifting back to earnings. The S&P 500 and Nasdaq are both eyeing recovery after their own tech-driven sell-off. These are not isolated events on separate continents. They are symptoms of the same underlying dynamic. Globally integrated technology supply chains mean that sentiment in semiconductors, AI infrastructure, and growth tech travels fast, and it travels together. Korea matters here specifically because its market is a dense proxy for semiconductor and electronics exposure. When Korean equities drop 10% in a short window and then stabilize only when earnings focus returns, that is the market telling you something precise. The sell-off was fear-driven, not fundamentals-driven, and when participants remembered to look at actual numbers, the panic softened. That is a meaningful distinction. Now apply that lens to the Nasdaq. The rebound attempt we are seeing in 2026 is happening against a backdrop where the underlying earnings data for major tech names is not obviously bad. The question is whether the selling that preceded this moment was a rational repricing or an emotional flush. History suggests both happen, often simultaneously, in different parts of the same index. The actionable insight here is structural. When you see correlated global sell-offs in tech-heavy markets, followed by rapid stabilization around earnings catalysts, the move is rarely about one company or one data point. It is about liquidity, positioning, and risk appetite resetting. Knowing that keeps you from making the most expensive mistake in these environments. Reacting to price action as if it were a verdict on fundamentals, when it is often just the market-clearing crowded trades. Here is the Micron situation, stated plainly, because the framing in the headlines is genuinely instructive. A tenfold profit surge, by any ordinary standard, that is an exceptional result. Profits multiplied by 10. And yet the serious analytical conversation is about whether the stock crashes anyway. Barron's framed it exactly that way. So what is happening? This is textbook growth stock mechanics, and it matters beyond Micron specifically. When a stock trades at elevated multiples, which Micron has, given the AI-driven semiconductor enthusiasm of the past 2 years, the market is not pricing what the company earned last quarter. It is pricing what the company is expected to earn over a multi-year forward window. When you already own the expectation, the delivery of even spectacular results can trigger selling if those results are now interpreted as peak, or if the guidance for future quarters is anything less than equally spectacular. This is not a new phenomenon. It happened with memory chip cycles before. It happens in any commodity-adjacent business where investors are trying to call the top of an upcycle. DRAM and NAND, Micron's core businesses, are inherently cyclical. The AI build-out created an extraordinary demand environment for high-bandwidth memory. The question analysts are now asking is whether that demand sustains, accelerates, or begins to moderate. A tenfold profit jump looks different depending on which of those three scenarios you believe. The broader lesson, and this is not financial advice, it is pattern recognition, is that earnings surprises move stocks in the direction of the revision to future estimates, not in the direction of the beat itself. If a company crushes current quarter numbers but provides cautious forward guidance, the stock often falls. Micron, sitting in this tension right now, is a clean, real-time example of that principle. Watch how the options market prices the reaction. That is where the genuine conviction lives. Cerebras went public, reported its first earnings as a public company, and the stock tumbled. This deserves more than a passing mention, because it represents a pattern that has repeated itself with remarkable consistency across the AI hardware and infrastructure space in 2026. The IPO process, by design, creates a valuation that reflects maximum optimism. The story at its most compelling, the addressable market at its most expansive, the competitive moat at its most durable. That is what gets priced into an offering. The first earnings report as a public company is then the first moment where that story meets the cold specificity of actual financial results. Revenue line by line, operating expenses, margin structure, customer concentration, and forward guidance. Cerebras is a serious company building AI chip infrastructure, a direct challenge to NVIDIA's dominance in AI compute. That is a legitimate and important technology story. But there is a significant gap between being a legitimate technology story and being a stock that performs well immediately after IPO, when expectations are already elevated and the operating history as a public entity is exactly 1 quarter long. This is not cynicism about Cerebras specifically. It is an observation about the mechanics of growth tech IPOs in a market that has been trained to front-run AI narratives. When the first report arrives, and the reality, whatever it actually is, does not perfectly match the peak optimism scenario baked into the IPO price, you get the kind of post-earnings pressure Cerebras is experiencing now. There is also a Tesla footnote worth connecting here. A victim's family has filed a lawsuit related to a fatal crash involving Tesla's automated driving assistance system. That is a material liability story. And it is a reminder that the regulatory and legal risk embedded in autonomous systems is not theoretical. It is litigation calendar risk that serious investors need to track. AI is not frictionless. The legal infrastructure around it is still being written, and the cost of that process lands on balance sheets. We opened by asking how a tenfold profit surge turns into a crash conversation. The answer: markets price expectations, not results. And right now, the expectation bar in AI and semiconductors is extraordinarily high. Micron, Cerebras, the Korean rout, the Nasdaq recovery attempt, they are all different expressions of the same underlying tension between AI cycle enthusiasm and the arithmetic of future earnings. The follow-up question worth your attention: what happens to AI infrastructure stocks if enterprise AI spending growth decelerates even slightly? That is the next video. Subscribe so you do not miss it.